Well, good afternoon on this beautiful September afternoon, and thank you for joining us for today's webinar titled Investing for Success as a Nonprofit Organization. My name is Jim Shellenberger, Partner and Director of Nonprofit Services here at McKonly Asbury. I've spent my nearly 23-year career in public accounting, all with McKonly Asbury, and literally from day one have worked alongside nonprofit organizations in various accounting, compliance, and tax capacities. Also joining me today on this webinar is my partner, Gary Dubas. Gary, would you like to say a few words?
Sure. Thanks, Jim. I've been with the firm working in the same areas with Jim, alongside of him, a few more years than Jim, close to 30 in fact with the firm, and excited to be with everybody here today. By the way, if anybody doesn't know McKonly Asbury, we've been around for, 50 years this year. And we're an accounting firm that does, you name it, audit, tax, consulting, numerous services, and a number of different industries, construction, affordable housing, of course, nonprofits, etc. And so if there's a need that you have, please reach out to us. And one other thing we should say is, I don't know if you've heard this or not, out there in our group tonight or today, Accounting Today named us the best firm to work for in mid-sized firms, and that is ranked #1 in the country. So that was recently announced, and we're extremely pleased with that honor, to say the least. We wanted everybody to know about that, and we're on high with that, quite frankly. So now let's get started. I wanted to introduce our guest today, Courtney Dean. She is, I love this title, Chief Revenue Officer for eCIO, an investment advisory company located in St. Louis that just works with nonprofit organizations. And we're pleased to have you here today, Courtney.
Thank you, Gary. Thank you, Jim. It is a pleasure and honor to join you both today and our audience. Yes, as Gary said, I am a nonprofit investment advisor, a partner, chief revenue officer, which means that my role is really focused on working with clients. I've been in the investment management industry for over 25 years. And at eCIO, which we started 5 years ago, my team and I, we are a fiduciary advisor that was built specifically for and is dedicated to servicing nonprofit organizations. So that is one reason why I was super excited to connect with Gary and Jim, others who are dedicated to the sector. As you know, that's our focus, and we love to collaborate with others who are focused on that as well. eCIO, we today work with 95 nonprofits around the country. We've got clients, I think, in 29 states now, and our focus is really on nonprofit organizations that have typically less than $25 million in assets. As we know, there are not a lot of great institutional quality investment service providers out there for that sector, and so that's really our focus, and I'm super excited to talk about nonprofit investing with you all today.
We're glad to have you here with us, Courtney. So a couple housekeeping items to get started. You should be seeing on your screen a polling question. CPE polling questions will be throughout today's presentation. So for those of you who are looking to obtain credit for today's webinar, please keep in mind that there will be 4 of them today, and you must answer all 4 questions in order to get your certificate. I repeat, you must answer all 4 questions, and you must remain logged into this webinar for a minimum of 50 minutes to receive credit. Unfortunately, we are not able to accept late responses to polling questions. Upon successful completion of the polling questions, you will receive your email via email your certificate in a few weeks. So let's go ahead and make a chance here to respond to this polling question. Okay, great. Thank you for those who have responded. There is no right or wrong answer. It's simply done to verify your attendance. So throughout today's presentation, if you have any questions for us, we'd love to have questions presented to us. Please use the built-in question function in the webinar control panel, and we will do our best to answer those questions throughout today's presentation. I look forward to having a great conversation with Gary and Courtney. And Gary, I'm going to turn it over to you to get us started.
All right, thanks, Jim. So we'll start kind of at the top. We're a nonprofit organization, and we've got a little bit of money to invest. Maybe it's from excess operating cash. Maybe it's a board designated amount that you want to have in investments, or maybe something a little more significant like an endowment that you've been blessed to have in your assets. And so first question I want to ask to Courtney is, what are some of the common challenges nonprofit organizations face when managing their investments, and how can they overcome these to achieve better outcomes?
Well, that's a big question, Gary, and let's jump into that. So look at the next slide on common challenges and pitfalls. In working with nonprofit organizations for many years, collectively as a team, decades, we've kind of assembled this list of top 10 list of very common challenges that we face with the organizations that we work with. Each organization is, of course, unique, but often the challenges are very similar across entities. And you know, I put this top 10 list. I'll briefly kind of go through these, but hopefully one or two of these strike a chord, maybe with someone in the audience, and we can do deeper dives on any of these. So number one, a very common challenge that we see is organizations that sort of sideline the start of a new investment program. They have assets, they feel like they should do something with the assets, but getting started is often a huge obstacle. And so, typically having an investment oversight group or committee is a great starting point. One successful approach that we've employed with organizations who are facing this is to start with a conservative cash management program. So get used to having an investment oversight group in place that works with the organization's staff, maybe an outside investment advisor. Get accustomed to forming policies, investment policies around how the funds should be managed. Get comfortable with having an investment or brokerage account, and start with a conservative approach to an investment program just for short-term cash. And then that often can open the door to establishing a longer-term investment program if and when that's appropriate. Related, but number two is that we have a lot of organizations that come to us with all of their investment assets sitting in a single account. So they've got cash reserves, maybe operating reserves, donor restricted funds, board discretionary funds, and it's all in one account. And we'll talk, I think later in this conversation, about the concept of the bucket approach. But we recommend considering an effective way of better aligning the organization's funds with the needs and purpose of the organization by segregating assets in distinct accounts that all have a distinct purpose, and then can have a specific investment strategy that aligns with the needs and purpose of the fund. So we can talk a little bit more about that. Number three is a big one. The investment policy statement, IPS for short, also the spending policy, which can be a distinct document but should be referenced in the IPS. A lot of organizations fail to have one in place, keep it updated, make sure it's monitored and adhered to. And so we are huge proponents of nonprofit organizations having a relevant, current, regularly reviewed and accessible IPS that can serve really as the cornerstone for decision-making on the investments. This is particularly helpful as we know that there is just a normal rate of turnover that occurs in organizations, both at the staff level and the board level. And so having policies and documentations is super important. And then kind of 4, 5, 6, 7, these are all kind of related. But when we engage with nonprofits, oftentimes one of the challenges faced is kind of a lack of thinking through how nonprofit investing is very different than personal investing. Obviously, as fiduciary stewards of a nonprofit organization's money, it is super important that everyone be mindful that personal preferences have to be put below the interests of the organization. Also, recognizing that unlike personal investing, when it comes to investing on behalf of an organization, there are multiple stakeholders. There are staff members that need to be kept updated on the program. You've got the investment oversight group that has typically kind of day-to-day responsibility for oversight. And then you have the board members who have fiduciary responsibility, who also need to have confidence in the progress of the investment. So recognizing that when it comes to nonprofit investing, it's super important that that multi-stakeholder model and recognition that the organization's interests have to be put ahead of personal interests is super important. Number 8 is that kind of short-term and emotional decision-making can be a big challenge. We're human beings, and when it comes to investing, it's very easy to get emotional and to make short-term decisions that are not in the interests of the organization over the long term. So that's a big challenge. There are a lot of things that can be done to address that, that the organization and its investment advisor should work towards. Number 9 is overpaying for investment services. So one thing that we can control when it comes to investing is costs, the costs. There are a lot of things we can't control. And costs are going to have a direct impact on the funds available for your mission. So it's super important for the fiduciaries of a nonprofit to understand the fees that they're paying, which is not always easy to discover, but you need to know what you're paying, be mindful of what those fees are, make sure that they are prudent, and that your organization's getting value for the fees that you're paying. So, and then finally, number 10 there is a good investment program really can and should be promoted to your donors. So encouraging donors to donate to the organization, tax-friendly ways for donors to give to your organization, like receiving appreciated stock, often a missed opportunity. That when you've got a good investment program in place, take advantage of that and leverage that with your donors.
Courtney, that's a fantastic list. Looking at it, and if we can, maybe just dive into one of these real quickly. I'm curious, like, what would you say is the #1 barrier organizations face to actually starting an investment program?
Yeah, I think starting a program, it's where to start. It's what are the steps involved and how do we start? So if you look at the next slide, I think a helpful framework is oftentimes an organization will say, we have money, we should invest it. Let's figure out how do we get this money invested in something. And really what we like to promote is the idea of 3 pillars to an enduring investment program. So governance is actually what we put as #1. So that's making sure there's a structure in place so that investment decisions can get made prudently. And so we can talk more about, some of what would go into governance, but I would say a great starting point is identifying an investment oversight group. So an investment committee, sometimes it's part of the finance committee, that can outline the steps necessary to get an investment plan in place. There's going to be policy documents as part of that. For the oversight group, there's going to be, defining purpose and needs and objectives of the funds, potentially, likely hiring an investment professional to partner with you. And so by getting that investment oversight group established, an organization can begin to kind of outline what's needed to build, to get an investment program off the ground. And again, we like to remind organizations that you don't have to jump into kind of an aggressive portfolio that includes lots of stocks. If the organization, or equities, the organization has never invested before and there's excess cash, it can be prudent to just think about how do we make this cash more productive for the organization rather than sitting in a 0 to very low kind of interest account. Is there a way that we can get some income in this on this cash that'll support the organization, and in so doing begin to put the kind of building blocks in place to build a long-term investment program?
That's great. That list, Courtney, on the previous slide is really resonating with some of our audience with some of the questions that are coming in. So if you don't mind, I'm gonna ask you about one of them. It's number 10 that was on that list about engaging donors. And maybe if you can, could you just expound a little bit on how to build trust and engage donors, particularly in the climate that we're in today, where a number of nonprofit organizations are actually seeing contributions decline. And maybe you can give us your thoughts on that.
Yep. Yeah, there's I'm sure a lot of folks in the audience are staying up to date on kind of fundraising trends and donor trends. There is, a massive transfer of wealth underway. The baby boomer generation is now at the point where we are seeing massive transfer of assets from that generation. It's about $84 trillion is the number cited. Cerulli is an organization that does a lot of research on this. $84 trillion is expected to transfer from the baby boomer generation over the next approximately 15 to 20 years. And the estimates are that I've seen are 12 to 14 trillion of that going to charities. So yes, most of it is going to go to the next generation, but of the baby boomers, there is a huge portion of their assets that are expected to go to nonprofit organizations. So that is an awesome opportunity for all of us to try to facilitate that transfer and help donors know what they want and need to know to feel comfortable about donating today and even into legacy. So one of the things that we see as an investment advisor with nonprofits is just a lack of communication with donors, lack of letting donors know how easy it is to donate to the organization, both for immediate support of the mission, but also long term to be able to make an impact that will be multi-year or maybe even multi-generational impact. And again, one of the kind of what I view as low-hanging fruit, when you have an investment account established, that allows a donor to contribute in ways beyond just writing a check or a credit card transaction. Because one very tax-efficient way for a donor to contribute to a charity is to gift appreciated securities, appreciated stock. We know the stock market, most of us know the stock market's done very, very well the last 10 years. So even investors with modest wealth who've had exposure to stocks have seen huge gains in those stocks, both in their taxable accounts as well as their as their retirement accounts, their IRAs. And there are huge benefits to an individual gifting that appreciated stock to a nonprofit versus selling stock and writing a check. So just being aware of what those tax benefits are, talking to donors about that, making it easy for them to have the information to gift the stock into the investment account for the organization's benefit. That's just low-hanging fruit that we hope more organizations take advantage of.
That's a great takeaway. I mean, I think what I'm hearing from you is every nonprofit should have an investment account.
Well,
right?
It allows you to receive gifted stock, and organizations that talk about it and make that doable, in our experience, definitely see results.
Great. All right, I think we're going to go ahead and launch our second polling question. So for those of you who are seeking CPE, now is the time to make sure you answer the second polling question. And that question is, which role best describes your position at your organization? So a little audience poll here. Are you a board member? Are you part of nonprofit leadership? Are you part of the finance department? Are you an external accountant or CPA? Or do you fit into that other category? Let's take a couple seconds here to answer this question. All right. As I would suspect, we have a pretty wide range of attendees here today. So you can see those on the screen, a good representative of board members, leadership, finance individuals, those CPAs in Pennsylvania who are looking to get their credit this reporting cycle, and about a fifth of you are other. So that's great. So Courtney, in preparation for this webinar, I went out to your website and you got a lot of great resources out there, and one of them was on this concept of the bucket approach. And I'm hoping, I know you will, kind of explain this concept to us, but really how this bucket approach strategy can help organizations better manage their assets and sort of meet their financial goals.
Yeah, absolutely. The bucket approach is something we've talked about for a long time, but we have recently put pen to paper and are producing a kind of a series of resources around the topic because it does get a ton of interest. And it's really grown out of, I mean, it's an industry term, but it's grown out of addressing the challenge of that organizations have where they've got different funds for different purposes. And rather than hold those all in a single investment account, which we see a lot of organizations do, we like to talk about the advantages to putting the funds into designated buckets. We have clients that have two investment accounts, a short-term and a long-term. We have clients with well over 10 different segregated accounts because the purpose, the donor restrictions, what have you, are so different, unique, that it makes sense to have those all separated. And the advantages of the bucket approach are kind of three here that we put out, is clarity and transparency. So when you've got funds segregated based on their purpose and use, it's just much clearer to everybody who's responsible for overseeing these assets, kind of what they're meant to do and be, and what's the status of them. It also is, an accounting framework. Talking to a bunch of accountants here, I'm not going to go deep on using the word accounting, but by having the bucket,
my favorite part. This is my favorite part, Courtney, right here.
Well, we'll let you chime in, Jim. So, it just makes it easier for the stakeholders to prioritize and make decisions about the funds, what's available to be spent, how the funds are being utilized, how they're being invested. So ease of understanding, and then finally just better decision making. Nonprofits just get much better insight into the financial management of the funds when things are segregated into these buckets. And then if you look at the next slide, we outline, kind of very typical categories of assets. Again, we see organizations with lots of buckets, but very common ones are operating reserves, So those are, those are there for sort of the daily stability of the organization. Kind of typically anywhere from 3 months, sometimes organizations want a year worth of operating expenses covered in that reserves account. The second one is long-term assets. Oftentimes this will be an endowment fund, sometimes with donor restrictions, sometimes board designated. The board has discretion over the spending, but these are assets intended to support the organization long-term, maybe even perpetually, oftentimes with kind of a view towards perpetual support. And then you've got designated funds. So these are funds earmarked for a specific purpose or project. Again, either with specific designation by donors who have gifted the funds or by the board. And then capital expenditure reserves. So those are funds allocated for specific capital investments. We work with, for example, in the affordable housing space, clients that have multiple facilities and keep reserve funds for each of those in designated buckets. And then the investment strategy, as you would imagine, for each of these is going to be quite different. So, the short-term reserves in that operating reserves bucket, those really shouldn't be exposed to a lot of volatility. So they're probably not going to hold, significant exposure to stocks and should probably be pretty conservatively invested, again, for stability and income. While the long-term assets that are, needed to support spending over the long run for the organization, those are going to need to have a return, an investment return profile that supports maybe a 5%, 4 or 5% per year spending, plus keep up with inflation of 2 to 3%. So in order to achieve that purpose, long-term assets are going to require more risk assets, but they can also withstand more volatility to reach those long-term kind of growth goals. So each of these buckets would have, specific investment strategy. They're going to have their own asset allocation, their own kind of percentage in stocks, percentage in bonds, percentage in cash. They're going to own different investment strategies to balance, more income versus more growth. And then you get segregated reporting. So each of these, you're going to get reporting that aligns with each of these. So again, just in terms of oversight, being able to understand the progress of each of these, where do we stand, are we on goal to meet our objectives? And then, one of the things, we're putting out a new resource next week on this topic of a recommended practice that we suggest is to have, in addition to these buckets, is a fund movement policy. So a policy around when funds should move between these buckets. So you add, for example, your checking account here, which you could argue is a bucket, may not be an investment program bucket, but your cash in the bank, your operating reserves, your long-term assets, establishing guidelines for how much to have in your checking account, when should funds be moved out of the checking account into the operating reserves to get some more income, and vice versa. And then, at what level in the operating reserves account have assets reached a point where the money should be moved to the long-term account and be able to be invested to generate more growth for the organization. So the fund movement policy to, again, just have some guidelines and guardrails around how much money should be in each bucket, when funds should be moved, and then of course who has the authority to move those funds.
Courtney, one question that came in is there such a thing as too many buckets?
Yeah, good question. Yes. Yeah, there is such a thing. We see a lot more organizations that have too few, that come in with 1 or 2 accounts that have such a diversity of needs and purposes within the funds that it's really difficult to keep track of. But we also do occasionally see an organization that has dozens of accounts.
Yeah.
And that also provides difficulty because when you have too many, it's also very challenging to frankly focus on them and keep track of them. So there's not a one-size-fits-all solution here. I mean, I wish there was a magic number. There's not. But spending time with an investment professional who can help with the staff and the oversight group to kind of go through in a case where there are a lot of accounts and determine, can some of these be combined? Do you have some with, in essence, the same objective, purpose, needs? Maybe they were gifted, maybe the funds were gifted by different donors, but the needs and objectives and purpose are similar enough they can be combined. We of course have to account for the separate donor funds, but from an investment standpoint, we don't need to have we don't need to have all these broken out.
Makes sense. Sometimes accountants try to overcomplicate things, and I could see that being the case for some folks.
I'm not familiar with that at all, Jim.
I think this is I think there's a great concept that I was thinking here is like with a capital expenditure reserve fund. You might be thinking, hey, in about 3-4 years, I'm going to have these funds to invest, but in 4 years, I'm going to have to then outlay those for a building addition, et cetera. So in today's increasing interest rates, you could really set some good, even interest-bearing conservative investments to come due, in 3 or 4 years. So putting them in buckets makes you automatically think a little bit outside the box.
Absolutely. Well said, Gary. And in fact, the organizations that have these capital expenditure reserves that we serve, a cash management program where you can match the time horizon with, the time horizon of the instrument you invest in. So as general principle of investing, the more risk, the higher long-term reward. The longer you're willing to invest the assets in, say, a fixed income instrument, typically the higher the yield. So if you can align, in a cash management program, align the interest-bearing security with when you want that maturity to occur, because you need the funds to invest, you can really maximize kind of the reward profile there.
Absolutely.
So yeah, we talked about, aligning the investment strategy with each bucket, and the investment policy statement. So we would recommend that the investment policy statement, which guides, again, the investment decisions being made on behalf of the organization, each of the buckets would be outlined in that investment policy statement. So what's the goal and purpose of the funds? What's the time horizon commensurate with that? Are these funds that are needed in the next 3 to 5 years? Are these, short-term operating funds that, with a policy for how they're going to be used in conjunction with the checking account, moving funds to and from? What's the return objective? How much is being spent from the bucket? And all of that then rolls into what is the mix of investment assets that we want? How much should be in very low risk interest-bearing securities? How much should be in bonds? How much should be in stocks? So you come up with that strategic asset allocation, which is really a critically important decision when it comes to kind of the long-term results in an investment program. And we can talk more about asset allocation, fully loaded subject. And then finally, the investment strategies. Again, are these investments that need to produce income? We want to produce income, or are these investments that that should be more geared toward delivering growth for the funds?
Great. We will go ahead and launch polling question number 3. So again, for those of you who are looking for CPE credit, please respond to this polling question and simply want to know have you previously heard of the bucket approach? Yes, our organization or your organization follows it. Yes, I'm familiar with it, or no. So let's go ahead and take an opportunity to respond to this third polling question. I'm very interested to see these results. Interesting. So about 43% are familiar with it, Courtney, but about the same amount have never heard of it as well. And then a small amount who do follow the bucket approach within their own organization. What do you think of those results?
Well, I think basically it says there's a lot of room for discussion about it.
I'd agree with that. I'd agree with that.
So it was already mentioned asset allocation, and what immediately comes to mind for me is risk. We deal with it all the time when it comes to the audits of nonprofit organizations and other entities, and nonprofit organizations have to think about risk. So how do they really invest, keeping in mind that they've got to have funds for operational needs, but they also want to grow and put those in the buckets for long-term growth. So how do you really balance that conservative versus also wanting to grow your investment portfolio?
Yeah, absolutely. I mean, asset allocation is absolutely a critical factor to successful investing. Really I would argue any type of investor, personally or institutional. We are big proponents of strategic asset allocation, as opposed to asset allocation that is short-term in nature. And most people probably know it's asset allocation basically is the division of the portfolio across market asset classes, stocks, bonds, cash being three predominant ones. There are alternative investments, and then within each of these major asset classes, there are sub asset classes. So making the decision about how much in equities we should invest in, then there are follow-on decisions. How much should be in US equities versus international equities? How much should be in large cap stocks versus small cap stocks? How much should be in more growth-oriented stocks versus more dividend-paying stocks? So within each of these asset classes, there are a lot of sub-asset classes, and asset allocation is coming up with the right blend of all of those. A lot of research has been done. The reason this is such an important decision is that studies show that 90% plus of the long-term return in investor experiences comes from the decision about asset allocation. So what's much less relevant is, did I own company A or company B? What's much more important is, did I own companies in stocks? So it's an important decision to get right. Back to the bucket approach, one of the beauties of that is, by having a fund with a pool of assets with a very clear purpose and objective, needs that need to get met, that helps a lot to determine what's the right time horizon, what's the capacity for risk that these assets can tolerate. Those are really critical things to answer before you can know how much of the money should be invested in stocks, how much should be invested in bonds, how much needs to be in very liquid cash or short-term instruments. And so there's a concept called the modern portfolio theory, which has been applied really widely in the investment industry now for decades. And the concept is that when you've got an objective, a return objective, and a risk tolerance that you can kind of define, you use the concept of modern portfolio theory to identify that optimal mix of these asset classes and sub-asset classes based on the volatility, the ups and downs that each of them has, the return expectations that over the long run you can have for these various asset classes, and then the correlations. So how these asset classes perform in conjunction with each other. And so there's an art to it, but quite a bit of science and data also, that once you can determine kind of what's the return objective, how much volatility or kind of downside risk can we tolerate, how do we expect these asset classes to move together over the next 20 years or so, then you can come up with kind of an optimal blend that results in kind of a recommended asset allocation. And I've got some slides based on the questions that kind of help tell the story with some pictures around asset allocation, how to think about it, and sort of the power of it. So the slide that follows is the long-term return of the various major asset classes. So it's that line chart there that shows stocks, bonds, treasury bills, and inflation, and it goes back almost 100 years, 1926 to 2023. And what you can see is probably not a huge surprise to people. The gray line is inflation. So that is over that time period what the rate of inflation has been, nearly 100 years, just under 3%. So that's how much, in essence, your money loses purchasing power each year. Then treasury bills, arguably the most conservative investment vehicle, short-term government-backed T-bills, those have returned 3.3% per year over the last almost 100 years. Government bonds, a bit more risk, bit more volatility. Those have returned 5.1%. Large cap stocks, so I think S&P 500 type stocks, those have returned 10.3% per year. And then small cap stocks, which these are going to be smaller companies, more volatility, more ups and downs. But over the long run, those small cap stocks have returned 11.8% per year. So what this kind of helps illustrate is if you've got a short-term pool of assets, inflation's maybe not a huge concern because you're going to be using these assets, over the next within 3 years, say. Probably a lower risk investment's going to make sense. However, if you've got a long-term pool of assets that you want to grow and support the organization for multi-decades, multi-generations, it's going to be hard to do that without stocks because government bonds have delivered 5% a year. And when you take 3% out for inflation, because that's the erosion each year that we would expect with the a decreased purchasing power, it's going to be hard to get much growth and support spending by investing in bonds only. So this just kind of helps, again, over the long run. This is the kind of return profile you get from the major asset classes. And then if we look at stocks and dive in, one of the questions we get quite often from organizations, especially those who have not invested before, is it responsible for a nonprofit to own much in the way of stocks? And when you look at this, shows the annual returns of the S&P 500. So the gray bars there shows since 1980 through June of 2024, so about 44 years. The gray bars are the annual returns of the S&P 500 in each of those calendar years. And then what you see in red are the declines, the decreases in the S&P 500 intra-year in each of those years. So if you look at 2023, year to date through June, the S&P 500 was up a very nice 14%. But if we look at 2023, it was up 24%. The S&P had a great year last year, 24%. Many were not expecting that, especially on the heels of 2022. But if you look at the red dot below that, you'll see that last year, the market was down 10% at one point. So stocks are volatile. is kind of the message here. And you know, we have to stomach the declines in order to get the benefits. What I would say is that despite those intra-year drops of the stock market, and I think in red you'll see the average drop is 14.2%. The market has been positive in 33 of 44 years. So the vast majority of the time, 3/4 of the time, the market's going to give us a positive return. And if we look at, you know, the past 50 years, while the market has dropped over 14% on average each year, sometimes more than that, the annual return over the past 50 years is 11.5%. So if you just put your money in and stomach the declines without making a change to your asset allocation, you know, your stock return has been well into double digits on average each year. And of course, some years it's less, and some years it's quite a bit more. And then, you know, the other concept related to asset allocation on the next slide is time horizon. Time is a huge friend to the investor. And so this chart shows rolling returns, rolling annual returns going back to 1950. So almost 75 years of data captured here. And what you can see is the shorter the time horizon, the greater the dispersion of outcomes we might experience. So the green bar there is stocks, US stocks, S&P 500. The blue bar is bonds, US government bonds, and corporate bonds, sorry, corporate and government bonds, very broad proxy of the US bond market. And then the gray bar is a 60-40 portfolio. So 60% in those US stocks and 40% in US bonds. And you can see over the 1 year period how wide a range the annual return might be in each of those. But again, the power of time when it comes to investing is huge. And so you see as you move right, the longer the time horizon you have, the shorter dispersion you're going to see in annual outcomes, the tighter it gets, and less likely you're going to have a loss. So even if you look at 5 years, while stocks have over rolling 5-year periods, the worst 5-year period has been -2% for a stock portfolio. It's also been -2% for a bond portfolio. That would be a recent 5-year period when we've seen a lot of volatility in bonds. So if you hold these over 5 years, worst case scenario has been -2% in each of those. But interestingly, that 60-40 portfolio, so portfolio that combines those two asset classes, 60% in stocks, 40% in bonds, the worst 5-year period has been a 1% per year return. So that's been positive, maybe counterintuitive. And then, looking further right, if you have 20 years owning a 60-40 portfolio, so a prudent, long-term diversified portfolio, you can see the best 20-year period, you've gotten 15% per year. The worst 20-year period has been 5% per year. So that would have been, periods that would have included the burst of the technology bubble back in the late 90s, great financial crisis, so significant volatility in certain time periods, which where we saw, stocks decline by 20-30% in single years. The recovery's been there. And so a 60-40 portfolio, you can see long-term average return is 9.3% per year. And then of course, with the power of compounding, starting with $100,000 over 20 years, that's almost, 6 times 20 years later. So anyway, time is your friend. We think that's a really useful graphic and framework to think through.
I think it's pretty remarkable to see that trend, Courtney, especially just within 5 years. Your risk really goes down significantly, which is remarkable.
That's right. And then this illustration is to hit home the point that strategic asset allocation, making that decision about how much of the organization's funds are invested in stocks, how much are in bonds, maybe other asset classes, and knowing that time is our friend. What we don't want to do is make short-term decisions that are not in the best interest of the organization. And this is a graphic. This one goes through 2020 is what I had, but it gets updated regularly. The story is always the same. And that is that the average investor doesn't do very well relative to the opportunity set of investments readily available. So, the green bar there is basically the 20-year annual return of the S&P 500 through 2020. So S&P 500 in this period was up 7.5% per year. A 60-40 portfolio, 60% in stocks, 40% in bonds, was up 6.4% on average per year. And then you look at the red bar. The average investor was up 2.9%. I mean, just a little ahead of inflation. And the reason that the research points to is because the average investor does not commit to the strategic asset allocation. The stock market drops by 25%. The inclination is sell stocks, reduce stock exposure. And that's what a lot of investors do. And we see a lot of nonprofit organizations. The investment committee sees a decline in the endowment, 10%, say, and gets worried and says maybe that we shouldn't, have this much stock exposure. We thought we could stomach it, but this volatility is hard to see in the report. Let's reduce our equity exposure. Let's move more to cash, to bonds, reduce our stock exposure on the heels of that decline. And then guess what happens? The stocks recover, stock market does much better, and the organization doesn't have much allocated there and misses out. So again, strategic asset allocation, having it documented in an investment policy statement, staying committed to the long-term goals and the investment strategy that we know we need to meet those goals is just, it's super important.
Great. So we will go ahead and launch our last polling question. So polling question number 4, asking you, does your organization currently partner with a fiduciary advisor? Yes or no, our board manages our finances, or no, our management team manages our finances, or you're simply not sure. So let's go ahead and take a chance to respond to polling question number 4. The results are coming in, and again, about a third of you are not sure if you partner with a fiduciary advisor, and a little bit more than a third of you actually do partner with a fiduciary advisor. So that's some interesting stuff there. So Courtney, we're getting into one of my favorite topics, which is around governance, but recognizing we have 5 minutes, I figured we could probably talk about this for a few hours, but we just have a couple minutes left. I thought maybe you could touch very briefly on some of the key responsibilities of board members regarding overseeing, their investment program, nonprofit investment program.
Yeah, absolutely. Yes, we could probably talk about governance for hours.
For now, yeah.
And so we could talk about, we do have, as you pointed out, we have a number of resources. eCIO, we kind of pride ourselves on trying to share investment governance best practices, articles, resources, templates, and so we have a lot available which we can touch on. And a lot of those center around governance because it is so important. Again, a lot of organizations think, an investment program, it's all about my investments. And it is about the investments, but it's also about the governance around the processes and the decision-making framework for those investments. So this is a nice graphic. It's part of a paper that we put out, so there's some kind of stuff around it. But in essence, the responsibility of the board of directors, and I'm sure everyone knows, the board members have fiduciary responsibility for the organization's assets. You know, there's duty of care, duty of loyalty, prudence. So in order to fulfill those duties, typically this is the kind of structure that we're going to see. The board of directors, in a nutshell, is the body that's responsible for approving the policies and the procedures around the organization's investments. From a day-to-day standpoint, generally, there's going to be an investment oversight group. This, again, an investment committee, sometimes it's the finance and audit committee, but it's the group that typically day-to-day is responsible for overseeing the investments. That group is going to write the policies and procedures. They're responsible for creating them. The board of directors is responsible for approving them. So a board will generally select that oversight committee. And again, there's a lot we can talk about there in terms of best practices for creating that committee, who's on it, how should decisions be made. We recommend having a committee charter. The investment policy statement is typically written by the investment committee, maybe in conjunction with the investment advisor. The board of directors should approve that investment policy statement, which includes the asset allocation program. They're going to approve the spending policy and make sure that you know, records are all being kept. The oversight group will generally be the ones, again, creating the policies for the board to approve. They will make recommendations around outside investment professionals that should be engaged for the board to approve. And then the investment oversight group is going to review the portfolio's performance. Generally, we recommend at least quarterly that performance is being reviewed and that the investments are in compliance with the organization's policies, particularly that investment policy statement. And then ideally, the oversight group will prepare, you know, some kind of summary report to share with the board, again, generally on a quarterly basis, with maybe a full presentation kind of once a year. And then the investment advisor, if the organization has one, will be responsible for engaging with all the stakeholders to do a needs and risk assessment, to do an asset allocation study, you know, backed by the data and research so the organization can decide the proper asset allocation. Your advisor will, you know, generally be the one making the day-to-day decisions on the investments in the portfolio and handle the reporting. So that's kind of a quick snapshot of how we see roles and responsibilities kind of divvied up by the three main parties.
And as you said, Courtney, you have a lot of resources on your website at getecio.com.
We do. They're free, available for download. We've got, you know, sample committee charter. So if you're, you know, if you don't have one for an investment oversight group, we give kind of best practices and a template there. Spending policy, we have an investment policy statement template. We have a conflict of interest policy resource. We talk about, you know, measuring performance, benchmarking your performance. So yes, those are all available on our website at getecio.com. We also are putting out new resources almost every month. Our new one's going out next week on, as I talked about, the concept of fund movement policy across your buckets. So if you'd like to get on our mailing list, where we share value add resources very regularly, which include market updates and new articles, feel free to reach out and I'll get you added to our nonprofit investment digest. And then we're on LinkedIn. So social media, we're pushing out, you know, nonprofit investment updates that way too.
Great, thank you, Courtney. And I'd like to thank everybody for joining us for today's webinar. And Courtney, a special thank you for such valuable information Very current, very relevant, and I think everybody here learned something. I know I certainly did. For those of you in the audience who might have further questions regarding today's presentation, please feel free to reach out to us, our team, and Courtney. We'd be happy to assist you. A recording of today's presentation will be posted on our website and all of our social media sites within the next few days. For those of you who have requested CPE and answered those polling questions, those certificates will be available in the next few weeks. A couple upcoming events to highlight from McKonly and Asbury. Please be sure to register for our next webinar in September, which will be held September 26th. This is a cybersecurity focused webinar titled Practical Applications of Conditional Access. I don't know what that means, but I will be certainly tuning in to hear that. On October 24th, registration is now open for our upcoming free half-day in-person seminar presented by our firm along with Community Strategies Group in Bloomsburg, Pennsylvania. So if you are looking to lead your nonprofit organization into the future and propel your mission to new heights, we encourage you to spend a half a day learning from fellow nonprofit leaders discussing obstacles and challenges this sector faces. Again, this is an in-person seminar taking place in Bloomsburg on October 24th. And lastly, registration opens tomorrow for our affordable housing seminar featuring AJ Johnson. This is being held in person in Camp Hill, Pennsylvania. And this training will cover complex affordable housing issues such as eligible and qualified bases, applicable fractions, credit calculations, placed in service issues, rehab projects, tax exempt bonds, and the list goes on and on and on. Again, this seminar will take place in person in Camp Hill on November 7th, and we look forward to seeing you there. And with that, thanks again for joining us, and please enjoy the rest of your day.
Take care.